In today's video, we're going to explain the 5 retirement plans with incredibly low failure rates. Every year, my company and I help retirees build retirement plans that achieve both their financial and retirement goals. The truth is, no single plan works for everyone, but there are plans that have incredibly high success rates. Today, we're going to break down exactly that. In this video, we'll cover the 5 retirement plans with amazingly low failure rates and how you can implement some of these strategies into your own plan. Let's get into the video. So the number one type of retirement plan with a lot of success is a retirement plan that has a dynamic withdrawal strategy. So what is this? Well, in short, it's a plan that allows you to have flexible spending so you can adjust your withdrawal rate based on your portfolio's performance and market conditions. So first of all, why would you do this? Well, there's a lot of research that supports it. And in fact, there's also a lot of research that shows that retirement plans with really strict spending and withdrawal goals are often going to fail your retirees and leave them short. And right here, I'm really looking at the 4% rule, where you withdraw the same 4% from your portfolio every year. There's actually a lot of research that shows that's somewhat of a poor strategy. Instead, taking a more flexible spending approach can really significantly extend the life of your portfolio. And if you adjust withdrawals up during strong markets and then down during poor markets, you can avoid depleting your savings too quickly. And that's going to lower the risk of you running out of money. So how do you do this? I'm going to suggest you to look into something called the Guyton-Klinger rules. Now, there's a lot of other different types of dynamic withdrawal strategies, but I think this one in particular is good. And they use something called guardrails to determine when you increase or decrease your spending. In essence, what you're going to do is you're going to have a plan to withdraw more in good years, and then you're going to scale back your withdrawals in bad years. And this is going to help you preserve your portfolio for the long run. And that's the dynamic aspect of this. It's less about extreme cutbacks in your spending and more about cutbacks in how much you're withdrawing from your portfolio year to year based on market conditions. All right, strategy number 2. Liability matching. So liability matching is a strategy that aligns your investments with your future liabilities. So you kind of ensure that your big financial obligations are going to be fully funded. And you can think of this much in the same way that pension funds plan for their obligations. This is the kind of strategy that sort of guarantees that no matter what happens in the markets, you're going to have the funds to meet your key obligations and expenses. Well, how would you go about doing something like this? Well, the first thing is you're going to have to identify your large liabilities. And you can do this in a couple of ways, right? One is, hey, I know that I want to fund, for example, my children's college education. Or I know that I'm going to buy a car every so often and how much I'll probably spend on it. Or I know that I want to take a $30,000 trip around the world, whatever it is. On top of that, you're going to have a good idea of your average annual spending. So you're going to know pretty much year to year also how much you're going to need to fill your obligations. So then you go, okay, I know kind of how much income I've got from, let's say, Social Security or pensions. And, let's say my obligations are going to be $100,000. And then let's say I know I've got $50,000 covered by pensions and Social Security. Well, now I need to come up with another $50,000. And then what you got to do is you go, okay, from my portfolio, I'm going to get X dollars of income. And then from the rest of that, I'm going to have things like bonds and CDs. And I'm going to know that they're going to mature. And I'm going to have, let's say, $50,000 of these things maturing each year to cover the remaining part of my obligation. And this is a great way to make sure, hey, I know what my expenses are and I can meet them. And then I don't have to tap the rest of my portfolio during a bear market if it comes down to it, because I know I had bonds and CDs and things maturing, meaning I don't have to worry about market fluctuations with that other part of my portfolio. And while liability matching ensures your most important expenses are covered, what if you want a strategy that both manages risk and captures market upside? Well, that's where dynamic asset allocation comes in. So that's number 3, dynamic asset allocation. Essentially, dynamic asset allocation adjusts your investment mix based on market conditions. And you're going to use strategies like trend following and momentum to determine when you want to increase or decrease things like your stock market and bond market type exposure. Why do this? Well, one big reason is there's substantial academic research supporting the effectiveness of dynamic allocation strategies that use trend following and momentum. This study that I'm showing you here, and I love to cite this, it shows that you could increase sustainable withdrawal rates by up to 50% more than those shown in common retirement strategies like target date funds, which are usually a failure, right? So there's actually a lot of research that shows target date funds, the most common default investment options in retirement plans, actually don't succeed at what they're trying to do, unlike dynamic allocation strategies like trend following. And so this study shows, hey, you could probably increase your safe withdrawal rate by up to 50% more than you could by using kind of the standard default target date funds. That's useful information for you. Here's another study I'm showing that these dynamic strategies, when compared to other really common types of asset allocation strategies, tend to have far lower maximum losses than other popular allocation methods. And why that's important, because it reduces your risk of abandoning the strategy. And that's a major risk that a lot of people don't talk about. Another important point of the study is that it also had the second highest total return of all strategies that were analyzed, which is great because, if you're worried about longevity, returns do matter. It's easy to avoid risk, just stay in cash. Now, I never want to suggest anything's a free lunch. There are trade-offs you have to consider with everything. And so, if you got to do your own research, I don't want to give investment advice on here. So, hit me up. I'm happy to send you research papers on these types of strategies so you can do your own homework. The best way to implement these is doing the research like I just talked about. You're going to get an idea of what are the most common methods for trend following, what's the length of time you want to analyze the trend, and then you make a rules-based strategy around it based on the most successful methods that you can find that have been proven out in academic studies. I use these in my own practice and, read a lot of academic research, and then I decide what's the best way to implement these in a practical manner. And you can do the same thing on your own too. Now, dynamic asset allocation is going to give you both risk management and upside potential. But if you're looking for a way to kind of ensure the base level of guaranteed income while still growing your portfolio, you might want to look into something called the floor and upside strategy. So that's number 4. So what is the floor and upside strategy? Well, it splits your portfolio into 2 parts. One part secures a guaranteed floor of income for essential expenses, while the other part seeks market growth for discretionary spending and legacy goals. I love this strategy. I utilize it in my own practice. I think it's simple for people to kind of think in these sort of binary terms and split their portfolio in these 2 different buckets. Why do this? Well, there's a lot of research from experts on retirement planning that support the use of this strategy to balance security and growth. There's a really prominent retirement researcher. I have no idea how to pronounce this dude's name. It's V. Bodie. It's spelled Z-V-I. And so forgive me for butchering it, but he points out the fact that everybody talks about stocks for the long run, and stocks are great, but they always underestimate the risk of stocks. And there's no mandate coming down from heaven that stocks always have to outperform. And in fact, they can be quite risky in the long run. And so he advocates for methods like this floor and upside strategy, because if you take care of your security first, the rest of your portfolio can be put in these risky strategies for growth. You can probably see that's been a theme of our videos so far. And if you watch my channel, that's always been a theme of mine. And so these strategies balance security and growth. You have a floor funded by safe investments, and you might use treasury inflation protected securities, regular bonds, annuities, especially immediate annuities, and I love QLACs. They're called Qualified Longevity Annuity Contracts, and you should look these up because they're a really good way to protect against longevity while paying you high income. You balance one part of your portfolio with those, you know you've got your security needs met, and then the rest of your portfolio can go into growth, kind of set it and forget it, and you don't have to worry too much about what happens on that other side of your portfolio. So how do you do this? Well, first, you're going to start with determining what are your essential expenses and get a pretty good forecast of your retirement spending. Then you have to construct a portfolio of strategies. Some of these are going to be liquid. Some of them might be annuities, and then others are going to be tips and other types of bonds. Could be rental income, right? I know a lot of people are keen on that, and that's fine too. But you got to make sure you're getting enough income kicked off, can cover all of your basic expenses. And then the rest of your portfolio, just throw it into maybe an index fund and let it grow. Obviously, I'm a fan of dynamic strategies, so I sort of use all of these in conjunction with one another. But if you don't have the time or interest to do all of that, here's just one simple method that can still be highly effective, and I think way better than just a 4% rule or doing a target date retirement fund. Now, this strategy ensures that your basic expenses are always covered while the rest of your portfolio can grow. But what we haven't talked about in really any of these strategies so far is what about maximizing tax efficiency in your retirement plan? Well, that's where our last point comes in, tax-efficient retirement optimization. A lot of big words there, but what do I mean here? Well, I mean, you need to have a dynamic financial strategy that goes way beyond just investing, and it's going to incorporate multiple tax-saving tactics like Roth conversions, tax loss harvesting, strategic asset placement, and optimal withdrawal sequencing. Why do this? Strategic tax planning is crucial to preserving your retirement savings. Anything you can save on taxes is going to significantly reduce your lifetime tax burden. And when you're really strategic about this, I could show you plenty of examples where people have saved hundreds of thousands of dollars over their retirement by coming up with a strategy. So all else equal, we could do everything else that we just talked about. But the person who incorporates the other strategies we mentioned, along with this, is always going to be better off. Now, how would you do this? Well, let me give you some examples. One strategy is during your highest earning years, you probably do want to save as much as you can in a tax-deferred account like a 401k, especially if you're in the top tax bracket. Then when you retire, usually people's bracket drops. So let's say you were paying 50% all in. Now when you retire, you might be paying, let's just say 22, 25%, so maybe half of what you were paying. Well, you've got this crucial period of maybe 7 to 10 years where you can do Roth conversions. So you were saving 50% on the way in, and now you're converting these at only 25%. That's just instant savings that drops your bottom line. You do this strategically, and that's where I talked about, literally, this could be hundreds of thousands of dollars in savings over time. Tax loss harvesting is another big one. As you're accumulating funds, every year you should be thinking about how can I harvest tax losses? So ideally, you have more than just a tax-deferred account. You'll also have a taxable brokerage account. And if you're saving in that taxable brokerage account, you're saving at a different cost basis as you go up. And during the course of any year, stocks are going to be down at some point. And what I always look for as a common threshold is every time stocks are down 10%, I have software that I look across my entire client base. I look at every single lot and I say, what lot is down? Because even if overall you're up on a position, you might have just bought into new shares and those could be down. So I might say, hey, sell 3 shares while they're down. I harvest that loss, and then you buy something similar to kind of maintain that exposure, and you take the loss. You keep doing this year after year. You can only reduce your taxable income by up to $3,000 per year, but the losses you don't use, they never expire, so you can carry them forward. And if you're really proactive about this, every single year you can pretty much reduce your taxable income by $3,000. That will add up to thousands of dollars in tax savings over time. But you got to start doing it now. How else do you do this? Strategic asset location. Simple things like place tax inefficient investments in accounts like your 401k. So for example, if you're a high earner and you're investing in bonds, put them in your 401k instead of your taxable account, or put municipal bonds in your taxable account that aren't taxed at such a high rate, if at all. And then you can put your stocks maybe in your taxable brokerage account, which are much more favorable tax-wise than bonds. Then you have optimal withdrawal sequencing. When you retire, and you have a variety of accounts. So you have a taxable brokerage, 401k, Roth IRA, HSA. You need to decide, where do I start withdrawing from first? Generally, what you're going to find is taxable account first, then your 401k, then a Roth account. That's going to sort of optimize your tax efficiency for you. That's not going to necessarily be best for everyone, so you're going to have to look at it based on your own individual situation. Regardless, by optimizing your tax strategy, you're going to ensure that your portfolio is as tax efficient as possible, and it's going to increase the longevity of your savings. Well, there you have it. These 5 strategies: flexible spending, liability matching, dynamic asset allocation, floor and upside, and then tax-efficient retirement optimization, are all backed by solid academic research and have proven to reduce the risk of running out of money in retirement. If you integrate these strategies into your retirement plan, you can create a powerful and really resilient approach that balances security and flexibility and growth. If you're interested in exploring how these strategies can work for your personal retirement plan, hit the link to my website in the description below, where you can book a complimentary call with me to see if any of these strategies make sense for you. Thanks for watching.